Hello, hello. Welcome to the English session. I hope you guys are all right. If you can hear me, please drop something in the chat. If you can't see the chat, please use my Telegram chat. All right, perfect. So, just a question before, what's most interesting for you, like Forex, indices, or crypto? Then I would start with that. What's your wish for today? Crypto, indices, or Forex? If someone is in here from the English session, if he wants to, he could drop a message for the English community, because for now we don't have an English Telegram group for the community, so most people don't got the message for the sessions, for the new sessions. It's the second English live session now this week. So if someone has contact to the English community, just send them this link, and so we have some more people in here, because next week I'm in Macau, and the week on top, then we start again with new sessions. So next week is it's a short break with sessions and a live trading room. You have no wishes? Are you new to the market? You don't have anything you want to know about? Okay. Then I will start with gold. If we are in the daily chart, I will just show you short what's my higher time frame drawings. So we have yesterday a bearish candle with a strong rejection out of this higher time frame PD array, the monthly open gap from February. And that indicates not a strong bullish bias, okay? It's the same what we had before. It's not extremely clear if the price will go upside again, like following the overall bullish context we have. It shows for at least today that it's very low probability for going higher with strong momentum. Okay, so we expected today the midpoint of this inefficiency, the consequent encroachment. You can see here 0.5. It also reached it, and we had both opportunities for short and long. Okay. On the downside, nothing changed since last Tuesday, and so our focus was on the lower time frame today because we needed structure for having some confirmation for a setup which is like not low probability, like mid probability or high probability for a short time. And we had this in gold and also in Dow Jones today. In the intermediate chart, also nothing special new for the technical analysis is here in the chart. So I just jumped directly to the 15-minute chart, and what we saw in the end of the New York kill zone. So at 4 p.m. 4 p.m. German time. You can calculate this, like if you want to trade to New York local time in your chart, you just have to do 6 hours less, okay? Because we are in Germany 6 hours plus to New York local time. So the New York kill zone ends at 10 a.m. New York local time, okay? Goes from 7 to 10 a.m. New York local time. And what we had there was the reaction right here from the premium wick from yesterday at the lower quadrant, okay? And we created engineered liquidity right here with equal highs. So we expected that it go higher to the consequent encroachment right here. And before market moves on, it's always the same. If we had external range liquidity, like in a trend, where we was on this day, then this is in the 5-minute chart. It's like on the highest point, okay, from starting from the day. This is our daily open gap, and that's why it's external range liquidity. So we expect the market, the price, to go to the internal range liquidity, okay? External range liquidity, we had a range. So we had also our equal lows right here. And for this sweep, what happened here, for this we waited, okay? I did a short long trade in the live trading room today in New York Open from I think from somewhere here. We had the first presented fair value gap. Okay, it displaced to a new high with intent, with momentum. So this was a significant imbalance, which the market likely will fill, and what you can refer to find an entry. If you expect the market to go higher to the consequent encroachment like here, and if you have open liquidity, like engineered liquidity, and that's why I went long here first try. It didn't reach exactly this point. My take profit didn't reach like 1 or 2 points. Sometimes happens this. It's normal, so you just wait then for your next chance. And the market here before came back to the order block. That's the last bearish candle right here is the order block. It's important because this order block is in a relevant zone, okay? It's order blocks or fair value gaps, imbalances, everything which forms at the right time is important, okay? You can't just draw in your imbalances or fair value gaps anywhere in the market. It depends on time. So we have right here 3:50 p.m. German time. That's called also the ICT macro window. It's a 20-minute window, 10 minutes before an hour and 10 minutes after an hour, where price is likely to deliver to a price zone where is fair value, okay? And this first presented fair value gap offers a fair value price. So that's why price references exactly here and drives higher, goes higher for keeping the bullish order flow we had, okay? And this reaction right here was on the top of this order block. So it's just a short retracement. It's the same principle. You have here your equal lows, and that's the sweep. And the sweep should, of course, also happen in the right time or in the right zone. Okay, so you have time and price. This was exactly at 4 p.m., so still in the ICT macro time in the 20-minute window. So you have high probability. If you have time and price and liquidity, you have high probability. You cannot expect that everything aligns. Okay, so because you are here in the premium range of this dealing range right here from this day, it's not extremely high probability, but you have an existing bullish order flow which showed intent to New York open, okay, and let open another inefficiency, the most important point, the consequent encroachment, okay? So you waited for the structure because it didn't go higher right here. From 4 p.m. you have the London close kill zone and waited for the price to get liquidity right here. You don't know how deep the sweep will go, so you don't know if the price will go just short below this equal lows right here or below this low or even deeper. That doesn't matter. You just observe this and wait for a for a CSID, like changing state in the library, or that the algorithm will keep up with the bullish order flow. And we had this right here. We had liquidity again at the right time at 4:36. It's called Hydra time. Okay, it's the 20-minute window at the half point of the hour. 10 minutes before until 10 minutes after the half hour. And we had a strong reaction right here, which went back to the consequent encroachment of the first presented fair value gap, refers back to the open to the high level of the opening range gap from the regular trading hours. The regular trading hours opening range gap you can see in the future chart. This from yesterday evening when the market closes in the future market, and today when it opens at 3:30 New York open, okay? And it reacted right here at the high of this opening range gap. It's called opening range gap. I don't know why my cursor is so slow. Do you see that also? Or only I see that? I will load the chart new. Yeah, now it's better. So we had the reaction on the top of the opening range gap. Okay, and we had a follow through this first presented fair value gap, and then we had right here again reaction multiple times in the first presented fair value gap. So this was the confirmation first that liquidity got here, and that's the internal range liquidity. So the market follows right here with intent, with momentum on the upside to reach. It will the algorithm will hunt the buy side liquidity, which is right here. That's the first checkpoint, and then it will reference and hunt to the next checkpoint, the consequent encroachment from the daily premium wick from yesterday. Okay, and from here on, we wait again for structure, what we did. So it could go higher. It could also just make another structure. We will wait for the PM session start at 7:30 p.m. and wait there for the first presented fair value gap also to have a higher probability for a new setup. Okay, before that doesn't happen, and before we don't sweep one side of this range, it's not a high probability setup, because it's the same principle. You expect external range liquidity, what you have, and then you expect internal range liquidity. It doesn't has to deliver to this point. It could be also enough if this one below this low, yes, but that's then just like mid probability or low probability to get into this long trade again. So for a re-entry, I would expect the market going lower to positionize myself long. Okay, because we have right now this as a dealing range. So the discount area would be in here. Okay, and if this happens, it will happen in the PM session, and it would be also good if we have like a new structure. So if you think logical, if the price will go down the next 30 minutes, is it then likely that it go straight higher, like directly, or is it more likely to build another structure down there because it needs time to consolidate a little bit and to prepare to engineer liquidity, because it would be not efficiently if the price goes down and straight up again. Okay, I mean, it can happen if someone twitters anything or so, but normally if you watch the structure, it won't happen very often. So for the expectation that the market will go lower, we could also trade a short to this area, okay, to the discount area, especially because we were here at the consequent encroachment, and before it goes higher, it goes at least below these equal lows. Okay, that's our point of interest, which we will observe. Okay. So much for gold. And indices, if we watch into the future, okay, into the futures of E-mini Dow Jones. You see here the opening range gap also. You can change it in the right down corner of your trading view. You go to electronic trading hours, and then you see the blue zone, which is not the regular trading hours. It's just the electronic trading hours, okay? And what I signed in here is also equal highs. So engineered liquidity, one time here, and also what we had right here. You can put these levels everywhere in your chart where you can see equal highs or equal lows, okay? That's like important levels which you always should consider for the potential of your setup. And we did a trade in the Dow Jones, just a small trade down here in the live trading room today. And in gold, how I said, it was one time here in the first presented fair value gap, didn't reach my take profit right here, 1 point or something, stopped me out with a little bit of profit. Try to go in again, because how I said, it's not necessary that these equal lows will be swept. It's just a possible outcome of the next setup, okay? And so that's why I tried here also to go long again, little bit stop loss, like 0.07%, and later I didn't went in again because we had New York lunch. And even if it would have worked out, I mean, you can do those trades, but on the long term, it's better to observe in the New York lunch. So from 6 p.m. to 7:30 p.m. because you have reallocation in this time mostly, and so it's normal that you miss some trades, okay? The goal is not to take every movement or something. The goal is to try your best, and if it doesn't work out, you wait for your next best chance, and the chance depends on time and not only on price, okay? So even if it wouldn't have been wrong to go long there, um it's not the highest probability setup. And the same we had in the Dow Jones. So I went long, took a little bit of the movement with me. I only had one position because we was also in the premium area, okay? And we also had right here equal lows, liquidity rests below here. If you have a strong bullish order flow like you have today, you can't predict this. You just, it's always like it's always about the probability. You can pick the best piece out of the setup out, okay? And for me, it was just the movement which we had right here at New York Open. So we had a liquidity sweep again below these equal lows right here to New York Open, and then it went for the midnight range and the daily discount wick and all those reference points what you have from your higher time frame. What is first New York MI? That's the first presented fair value gap from Wednesday. Okay, I sometimes I have the names, the shortcuts in German but you can see this with the color. Okay, so this color is always my first presented fair value gap from the New York Open, and the first presented fair value gaps from other sessions like London sessions or pre-market or PM session. I only have for the actual day in my chart, and on the next day I delete it out because it's not so much relevant anymore. So how I said, if I would have been with multiple positions inside of the Dow Jones, of course I would have taken way more. Okay, you see how much it raised, and that's why also indices are or can be more profitable because they are more volatile, and of course you don't pay any commissions or something, or less than if you trade forex, for example. So it's, if you have a high probability chance, this is indices are really good for pushing your account. It can really push your account on time, and you don't need to take, how I said, every movement. You just have to pick out the best piece of the cake. And I took until here, until the consequent encroachment of the opening range gap. We had then a retracement into the first presented fair value gap right here in the Dow Jones. Violated it a little bit, but we had a strong momentum move on the upside again. Reacted here on the upper quadrant of the opening range gap, went lower again, created equal lows. So that's engineered liquidity for a longer time. So that means you have more liquidity down here. The longer the zone is where engineered liquidity builds up, the stronger the move after it will be. Okay, and sometimes if the market structure is not extremely clear, you just have not only one sweep, you have two sweeps, and that's why you get stopped out. Okay, that's normal. So if that happens, you just wait. After you get stopped out here, wait for it to come up, if it's like with intent or if it's slowly. Here was it again with intent after or let's say at in the middle of the London close kill zone, and then you had right here again your equal lows in as a micro structure, and the sweep. Okay, and the sweep happened shortly after the ICT macro time. That happens also. And what's important to know, the algorithm never delivers before the ICT macro time. It always delivers during this 20-minute window or after it. Okay, so a little, if it's 1 or 2 minutes after it, it can happen often. It's normal. And if the sweep, the most important is the sweep, like when the liquidity got jacked. Okay, so when the algorithm referenced to a specific price zone, like here the low of the opening range gap. Okay, and it got here liquidity again below this low and this low, and then the move to the upside came. Hard to get. I didn't trade this also, but it was a potential long setup you had right here, because you had the strong momentum. If the price would have go higher than this, like had the closing price right here and would have come back lower again like it did here, then I would have taken the trade. But how I said, when the order flow is extremely bullish, you don't get these chances normally, and that's also good because you don't expect it to go lower if you have a strong bullish momentum. but that makes it more difficult to get like accurate entries, because you don't have anything where you can reference your setup for. And that's why you can't say afterwards, look how it went up, and you could make so much profit right here. That's just bullshit. Let's be honest. If everyone can get a trade for a few weeks and being profitable for some months, but on the long term, nobody can take those trades on a daily basis. Okay, so if someone means he could do that, don't believe it. It's just luck. It's gambling. It has no structure, because if you have rules and you stick to your rules to be profitable for years, then you miss those trades, because it's just a structure which is hard to trade. Maybe ICT can do that, okay, but he does that for 34 years. And I'm not ICT, and I also don't know anyone who trades more than 10 years the ICT system, okay? No, but because ICT published his system like 10 years ago, or maybe 7 years ago around. So nobody can say to you he is for years profitable with such a high let's say trade frequency. Okay, that's just nothing in reality. So we didn't got a next re-entry for this long. Doesn't matter, we wait for the next chance. And that was the Dow Jones. What's important for you to know, if you have the opening range gap, there's a probability. So if you have the opening range gap to New York Open was right here, okay, right here, and the opening range gap consequent encroachment is like not near to it, it's like it shows you potential, then you have a 70% chance that this consequent encroachment of the opening range gap gets balanced until 4 p.m. Okay, so in the first opening hour of New York Open. That's how the algorithm works. And today was like a perfect example for this. It's not always that beautiful, like we had it here, like pretty fast. Sometimes it can also here happen with a second sweep or something, okay? But this is really like a perfect example for this principle of finding or trading a setup with the opening range gap in the indices, okay? And if you have multiple positions, you can put your take profit once here, once on the next level, once on the high of the opening range gap. And maybe if you are a little bit more risky trader like me, then you would also have taken this maybe here at the opening price, or let's say with the opening price after it closes again on the top of the first presented fair value gap. That would be also absolutely legal, because it's the same principle. You had liquidity, you had intent, and you have you have the first presented fair value gap inverted again. Okay, so it delivers price now to the upside, to the buy side liquidity after it got the sell side liquidity, so the internal range liquidity. So the most probability draw on liquidity would be the buy side liquidity right here, and that's the same like in gold. So you have always the same principle: time, price, and liquidity. So much for For the Dow Jones, we go now to Bitcoin, I would say. What's important to know, if you trade Bitcoin or in general every crypto asset, you need to know that the ICT system works also there, but not that reliable like in liquidity-based assets, okay? Crypto is more retail-based from so of the liquidity, and that's why it's less reliable. Also, ICT says that he doesn't trade Bitcoin. Okay, it's just that people trade Bitcoin with or crypto with the ICT system comes from other people who also trades the ICT system and say it's possible. It's possible, but it's just not that high probability. So you should be very careful if you use the same principles which you have in gold or indices or forex and use it for crypto, because in general you have the liquidity in crypto which is more retail based. Okay, that's why you can't rely on it so much with a high probability. Just for example, today we had yesterday, this week, that's our premium wick from yesterday. We had the bearish candle. We got liquidity over the candle from Tuesday. And if you watch then the lower time frame, it was the same principle, okay? So you had right here your equal lows, you had your sweep, okay? And in the 1 minute chart, you also had your first presented fair value gap of the New York session, okay? So at 3:30 p.m. New York open, you had a displacement, price comes back, reacts right here, goes lower to hunt the liquidity below these equal lows, builds a structure, and you see this takes also longer than in gold or in Dow Jones. It's not like a short sweep. It's likely to go more often and do 2 or 3 sweeps, okay? And that's because it's crypto, okay? That's why it's less reliable. And that's why you have also a less quote of your trades which will be right. So you should definitely trade with less risk if you trade the system in crypto. And also what you see right here with the first presented fair value gap, you have a small first reaction, a second reaction, but then it's not that accurate like in gold or in the indices or in forex, okay? Because the liquidity is not from it is mostly not that deep anchored like in gold or in the indices. So that's why you would get stopped out, for example, right here, but the structure remains the same context. It's the same principle. So it went to the downside, got the sell side liquidity, goes on the upside again, does here the market structure shift over the last swing high, comes back, and what you also can reference to is this small dealing range, okay? So if you have here the dealing range in the 1 minute chart from the market structure shift, you would expect that for a high probability long that the price comes at least to the consequent encroachment, but you can't use it like isolated, okay, isolated, because it always depends on the structure. And if you have some swing low like here with the red candle, which is a swing low in between this movement, then it's enough for the market to go like 1 or 2 points below this low to get the liquidity, And if the bullish order flow is strong, you have the same principle. It references right here and has an immediate rejection with intent, with momentum, and then it follows to the buy side liquidity until the strongest point, the midpoint, the consequent encroachment of the daily premium wick from yesterday. So that would be definitely a take profit. You can also have an earlier take profit at the lower quadrant or the mid quadrant. Okay, that's your take profit levels because the algorithm references to these points. Also, when it's not that accurate, like in other markets, you should still use the same context in crypto. And after this, we had a retracement. It was external range liquidity again, goes to internal range liquidity below this swing low, gets the liquidity, first reaction, then you had a stop hunt only one time, and then it went up again, okay? And what's also important to watch for a confluence. So if you watch the 3-minute, 5-minute, or 15-minute chart, you always have to compare. You always have to compare if everything aligns with the higher time frame. So if you watch the daily chart, the daily wick from today got liquidity below the previous daily low from yesterday, and now it hunts the buy side liquidity. Okay, so you had sell side liquidity, internal range liquidity, and now it hunts for the external range liquidity, or let's say the buy side liquidity. Okay, it doesn't has to go this high. It can also reject from there where it is right now. That would just be a potential next zone for a take profit, okay? Because you have because you had already right here the liquidity jacked from this high. And so if it goes higher, it can go, but it's unclear because it left open down here equal lows, okay? If you see this, it's you have like more risk that the market goes extremely higher before it didn't got the liquidity down here. So it can also happen that you have a fake out like this fast and then a drop, okay? And if you have then some inefficiency like a fair value gap or something, you can trade here short, and then your drawn liquidity would be the equal lows right here for short-term time, okay? Not for days, not for hours, maybe just for the next minutes or something, because Bitcoin and crypto can be volatile, and that's the things what you need to observe, okay? If you watch the whole thing in the 1-minute chart, you can see that after it got liquidity down here, we have a so-called changing state in delivery. So the algorithm changes its state of delivery from sell side to buy side, okay? And that was right here. That was right here with this 1-minute candle. It closed above this big displacement bearish candle what you had here, which made a lower low like here, and then it got inverted, okay? It got inverted, and now this inefficiency delivers to the upside. So, and what you see right here is like also an immediate rejection. It's hard to get, hard to trade. If you would have go long right here, let's say at the closing price, you still have to consider your stop at least below this inefficiency, because it can wick down. The wick can do the damage. What would be more conservative would be below the last bearish candle, okay? Because the wick does the damage, so it could go here, and the body tells you the story, okay? So this can happen many times, and that would be the first entry. A re-entry, you have to also watch the 3 or the 5 or the 15-minute chart, and then you also have right here your busy, where the lower reaction was, okay? And that was also not the consequent encroachment of this imbalance what we had right here, buy side imbalance, sell side inefficiency. It was the upper quadrant of this inefficiency, okay? So you can put right here your levels, and if it's a strong bullish order flow, you don't expect with 100% that it goes to the consequent encroachment. You expect it to react on the upper quadrant 0.75 or at the high, okay? And you can also see that the candle's body respected this zone pretty accurate, okay? And because it's fractal, you always have to compare the time frames. You can't rely and trade just in the 1 minute time frame. Then you have low probability. You always have to look for alignment and for the higher time frame direction. So you have overall a high probability. The same thing right here. You watch in the, for example, 15-minute chart, okay? 15-minute chart, you have the same right here. It's the busy. This candle made a higher high. It's a displacement. That's why it's relevant. If you see a displacement or a fair value gap which didn't do a structure break, it's less probability. And also this displacement or this fair value gap is also not the highest probability, because it formed outside of a kill zone, okay? You have here 7 p.m. That's not a kill zone, that's New York lunch, and that's why you have less probability that the price will go directly from this higher. And that's why until now you only have also again like equal highs right here. And before it goes higher here, I would expect now that it goes again lower and make a sweep, okay? And maybe reference to the order block we have right here. If you watch in the 3-minute time frame, then you have right here the last bearish candle. That's your order block, okay? And if you don't have a wick, a big wick like here from this candle, you don't have a sensitive zone. So what you do, you take the whole order block from the highest point of the wick to the lowest point of the wick, and then you take the midpoint, of this order block, the consequent encroachment. You can set it in your inefficiency with the middle line, and then you have here the middle line of the order block in the 3-minute time frame. Or if you want to also compare it with the 5-minute chart, it's also perfect, because you have here almost the same order block at the same price zone, okay? So the order block in the 5-minute chart would be this big. So the consequent encroachment would come down a little bit more. It can happen that it goes on the upside before it comes down, yes, but it would be from this dealing range again in the premium, okay? So you should be also careful right here for an re-entry long, because you always have to consider the structure. Until now we had here a liquidity sweep, and if the price comes down right here very fast, I wouldn't go long here again. It's not high probability. We want the price to go into this imbalance like slowly with structure, okay, and not with one candle, because that shows weakness of the market, and then we potentially get a market structure break to the downside with the closing price right here. So then I would watch more likely for a short, which I can trade for the next few hours or few minutes. Okay, so that's how you define your trade entries from minute to minute, because it can change also from minute to minute, also depending what Trump or anyone else is posting on Twitter. And for now, you have the chance for both sides, but what will be confirmed, you have to wait for the right time. Okay, always the time always confirms if your setup is valid. If it's not confirming, it's not high probability. And that's also why you shouldn't get irritated by these fair value gaps, because it's just a level in your chart which you observe. Okay, it's nothing guaranteed. Guaranteed is it's just with the time and price and liquidity and structure. Yeah, so that's for now for Bitcoin. Where we have the first presented fair value gap from here, from the PM session, we have right here. Okay, it displaced lower from this low, got inverted, came down here again, and if we wouldn't be in crypto, I would definitely say you have a mid probability for a re-entry long right here. But because it's crypto, and because this inefficiency didn't form at the right time in a kill zone, I would likely speculate that the price will go deeper. Okay, so I also wouldn't go in if the price comes in here like one time and react like one time. I would wait 2 or 3 minutes until I have some reactions right here. Okay, so don't go into your trade at some first reaction when you see in the 1 minute chart. You always have to have some time where for the algorithm to build liquidity. Okay, and you can't or you shouldn't bet on the highest point or the lowest point to get into your trade. That's absolutely nonsense, because you can't predict this. Maybe ICT can after 34 years, but even me, I can't, and I don't know anyone who can do this. Okay, and everyone who posts always sniper entry or something, that happens also to me, but it's not strategy or planned. You can't do this on a long-term basis. You can do this maybe a few times if it's luck with your strategy, with your rules, but it's definitely not planned. So you shouldn't give too much about those sniper entries. The most important question is also how much risk you had per trade. Okay, it's not about how many pips you made, it's about how much risk you had compared to your capital. And what's the outcome of this trade? Everybody can do like one-to-one trades with the chance risk. Okay, but it's for me it's bad. I choose trades where I have a potential with high probability with a chance risk comparison with at least 1 to 3 or more. Normally 1 to 5 or 1 to 10. That's high probability. If you risk less but can win really much, and this for long-term time, okay, not just 1 or 2 times. Everybody can do that. And for if you trade some prop firm things or something, the rules are so strict there. You can't say I have no stop loss. Then you won't get the max allocated capital in any prop firm, because when you don't set any stop loss, the prop firm says buy. And if you have a private account, sure, you can have more risk. You can also have 10% drawdown or something, but that's not a good risk ratio for long-term trading business. Why would you risk 10% for making 2% or something? That doesn't make any sense. So anybody who tells me, dude, I got so much profit or something, the first question I ask him, how much did you risk? And how often did you reproduce the setup? And that's the question where they got quiet, because they know they talk bullshit. So don't let confuse yourself with players in the market. Okay, keep it up to the reality, and keep it up to those who can explain to the trades to you why they did it and why they didn't do it, and don't believe too much from the internet, because the mostly things in the internet is just noise. Good. So far today, I hope you could get something for your trading. If you have any questions, write me on Telegram, and then we see us after Macau on the week. Let me think. We have right here. Yeah, 21st April, Tuesday, we have English live trading room and English session again. And until then, I also have a Telegram group for the English community. So I wish you a good evening and see you there.
Thank you for watching this video. Please subscribe our channel to get latest crypto trading prediction guide and tips, and write your opinion in comment box. If you like this video, you can like it and share it with your friends and others.